Markets are bracing for a pair of key inflation data points due today and tomorrow on producer and consumer price indexes. Ahead of that, let's talk markets now with Gabriela Santos, Chief Market Strategist for the Americas at JPMorgan Asset Management. Gabriela, great to see you.
Hello, good to see you.
So it's amazing to think that just a week ago we were sitting here looking at the rubble and confusion of the previous Monday's close. NASDAQ, S&P down 3%. What questions remain from last Monday that haven't been answered yet?
So I think when we were sitting here a week ago, we were trying to figure out how much of this is just technically driven, which we think a lot of it was, that really amplified the moves. So the question now is how much of that technical unwind is still left, especially of the yen carry trade. And it's very tough to put numbers to that. But there's some estimates that it's about 65% of the way unwound. So the worst of the technical pain is behind us, but it doesn't mean things can't still be a little bit choppy from here. And then the second bit is what has actually fundamentally changed? And is there a need for an actual positioning adjustment? And there, I think the macro didn't change dramatically. We think recession fears are overblown, but the balance of risk has changed, and we do think it does make sense for the Fed to bring forward the rate normalization, much more so than before the jobs report. So the number one thing that's changed for us is we have got to add duration. Rates are clearly coming down fast. A lot of investors are positioned short duration, and now is the time to add. And we think 3 to 5 years makes sense.
So what makes you think recession fears are overblown, and yet at the same time, you think the Fed should push forward its rate cuts?
Because I think from their perspective, right now they're sitting at the top of the mountain here with restrictive rates. I mean, we can argue all we want how restrictive they are, but clearly they're having an impact on housing activity, on big durable goods purchases, on the lower income consumer. So they feel like they need to get back closer to neutral rates, which estimates point to around 3%. So if the economy is downshifting, it's slowing. If the momentum of the labor market is slowing, the balance of risk makes it so that they should get to that 3% neutral rate as soon as possible. And really, it's still a normalization phase of rate cuts. It's not an easing phase, which would then occur if indeed we get closer to a recession. So you can have both, still an okay economy, while you still have 200 basis points of rate cuts over the next 18 months.
So do you feel that the equity markets on the equity side versus the economist side, do you think that there's a little bit of being off sides here, though? Because from the equity perspective, as you said, it is the belief that a lot of this was technical.
Yes.
And it was not necessarily, it was like a little bit of growth scare, but most of it was technical because we're basically, okay, now we're up 3% since Monday. And yet on the economist side, everybody, including JPMorgan, I know that's another part of the house, tripped over themselves to bring forward the rate cuts. I mean, say 50 basis points in September and November, which is the JPMorgan view, just as an example.
And to raise their expectation of recession as well.
To 35%.
Yeah.
That is dramatic.
So I think 35% recession risk still means 65% no recession risk.
Okay. Right. But so how about the 100 basis points in cuts by the end of the year?
To bring forward, just because we're so restrictive, we need the Fed. We agree with that other side of the house that the Fed should bring forward those rate cuts, not because recession's the base case, but because the momentum is slowing, recession risk has gone up, and they should get closer to neutral as soon as possible because they're still at very restrictive rates.
And that one jobs report is why. Because that's what I find so interesting. The jobs report was why, and then the jobless claims report, which nobody ever talks about. All of a sudden, that was, okay, we're off to the races again. We're fine.
And I think it's the whole mosaic of the labor market. And Chair Powell had talked about this on July 31st before the jobs report, right, that they were seeing several signs of some slowing in demand for creating new positions and for a slight rise in unemployment claims. That's all, right? The mosaic was just showing the labor market was slowing. That's it. And then the jobs report confirmed that. So I think the Fed had already prepared us a little bit before that they see the balance of risk as such that it is important to start reducing the restrictiveness. And I think for the equity market, if we take a look at what suffered the most during the sell-off from July 16th until the Monday low, it was the Mag 7, which fell 14%. The rest of the market fell 4%. So to me, the economic change, the rates change, impacted the bond market, rightfully so. For the equity market, it's much more a story of good, not great enough tech earnings, plus the technical factors, and that's appropriate. One read-through for the equity market is previously we had that rotation to small caps, and we were saying it's too early for that. The economy is slowing, and that's one thing that we don't see coming back. There's still plenty to play for in large cap within some quality cyclicals, but without having to go full small cap.
One thing that was surprising to me last Monday, I was on the phone with a lot of family offices and ultra-wealthy investors, and no one I talked to was buying on the dip. And they were still holding a lot of cash. Some of them were putting it into longer duration bonds.
Yes.
So what should everyday investors be doing right now based on what you're seeing?
Yes, I think three things. The number one thing is duration, right? Because I think for a lot of investors, maybe they had already bought equities, but then they didn't care for fixed income because the curve's inverted, cash rates are doing great, so why bother
so does that
with
mean,
a tricky fixed income?
In simple terms, going out to 10s, what, 5s?
No need. I think right now a lot of investors are in T-bills, so there's no need to go to the other extreme, 10-year, 30-year bonds. I think a sweet spot is 3 to 5 years. You're locking in the income we have because clearly rates are going lower. Wink, wink, nod, nod by Chair Powell. And number two, that's the part of the curve that's coming down to reflect those future lower cuts. And so you get a little bit of some price appreciation. That's where I think a lot of portfolios are offsides. It's still cash allocations, not a core fixed income allocation. And half the flows last week went into intermediate duration fixed income, rightfully so. And I think another one is to look at periods of sell-off for portfolios in equities that have been very concentrated on Mag 7, for example, here with U.S. investors, and see, well, where has the fundamentals not changed, but the price has gotten better? And for us, a clear action call, Japanese equities, which we're very much believers of and think was very much technically driven.